Today, folks, don't do it. I'm telling you now, don't buy VFV in your registered retirement savings plan. In fact, don't buy any US converted CAD value stocks. This is including things like global market ETFs, XEQT, VEQT, and I'm going to explain to you why, because I've been detrimenting my own registered retirement savings plan doing this, costing me thousands of dollars in the decades to come, and I'm hoping to save you from this mistake. Now, obviously, it has a lot to do with a word many of you are aware of, two words, that is withholding tax. And I'm going to break down why. So if you're on a path to financial independence, if one day you'd like to retire early, at least join me on that journey, guys. Let's try and do this together. Hit that subscribe button, because many of you know in my registered retirement savings plan, you OGs to this channel, I've been mainly just buying US dividend stocks because I recognize that the US government says, hey, if you're a Canadian buying our companies, making US dollars, as that money goes over the border, we're going to withhold 15% of it. But under this tax sheltered account, thanks to some treaty, the Canadian government says, no, we're actually not going to charge you any withholding tax. And this is one of the few accounts that gives you that luxury over things like the TFSA. And I mainly was a US dividend investor until I pivoted more toward growth and started buying VOO. And on top of that, I wanted some global market exposure, so I only recently started adding XEQT. But I've come to recognize this is probably not actually the most tax efficient thing for me to be doing. Because sadly, I have come to realize that when you are buying anything, because XEQT is like 45% US holdings, but I don't get the benefit of that 15% withholding tax waived. I'm going to explain to you why that is, but so many Canadians, and especially with the onslaught of Wealthsimple and a lot of these new tools that you can use to buy US stocks in a Canadian converted value, you don't realize that those are only efficient under certain accounts. And a lot of people might just be blindly buying these across all their accounts, not realizing they're leaving a lot of money on the table. Now, VFV has become very popular because it saves Canadians from converting the currency themselves. It's automatically converted in the stock price, but don't be fooled. You're still paying fees on the currency conversion, and in fact, regardless of where you hold this, you're still paying the withholding tax, which again is something new that I only recently found out. But if you take a look, VFV, for some reason, it's up 14% year to date against VOO that's up 17%. You might be asking yourself, if these are two of the same stocks. They both hold the 500 largest US companies. They're both weighted the same. Why is VFV underperforming VOO? And it has a lot to do with the Canadian dollar, right? Like if the Canadian dollar starts performing well, guys, against the US dollar, you're going to actually see VFV underperform. VFV will perform its best when the Canadian dollar deteriorates against, the US market growing. And this year, we've actually seen the dollar do slightly better than the US dollars. The US dollar has been correcting a bit. I know this can be incredibly confusing. I'm just trying to keep it as simple as I can for you. But you're actually better off converting the currency up front and buying something like VOO in specifically the registered retirement savings plan. And I only recently found this out, but basically, an RRSP account, the 15% US withholding tax on VFV is unavoidable even in the RRSP because VFV is a Canadian domiciled ETF. The US-Canada tax treaty does not prevent this specific tax from being applied to Canadian listed funds. In fact, it holds true for XEQT. The RRSP exemption bypasses you, not the fund. The Canada-US tax treaty provides an exemption from US withholding tax for Canadian residents who hold US listed stocks or ETFs directly in the RRSP. Since XEQT is a Canadian fund and is the direct owner of US assets, the US tax is applied at the fund level before any distributions are paid to XEQT shareholders. This happens regardless of whether the shareholder holds XEQT in an RSP and a TFSA. So I feel like there's been some, misconceptions out there, considering you're not avoiding any currency conversion fees. They're put into the management fee and they're kind of hidden along the way. And you're paying about 0.09% for VFV over the 0.03% you get out of VOO. So on top of that, if you're holding this in any account, you're still getting that withholding tax, guys, on the dividends. So you're kind of getting double detrimented if you're not paying attention to what's going on here. And it kind of blows my mind. So what should you be holding maybe over XEQT or VFV in a registered retirement savings plan? And it's simple. Just hold the US fund equivalent. So in my opinion, there's a lot of options out there for global market funds. I think a lot of people in the US would reside down toward the Vanguard Total World Stock Index Fund. And now to some extent, I'm thinking if this is the more appropriate way to go, I'm probably not going to sell the XEQT I hold, because let's be real, if 45% of the fund is in the S&P 500, I'm really only having like $10,000 of my total investment sitting there, and the withholding tax is going to be pretty negligible. But regardless, again, if you're building up a massive position like I am in the S&P 500, guys, I mean, if you start getting hundreds of thousands of dollars in these stocks, like that could equate to literally tens of thousands of dollars in the coming decades in compounded loss returns, thanks to that 15% withholding tax alone. So again, like I would just pay attention here. VFV, I think, is a great ETF for your TFSA, your regular brokerage accounts, but with that RRSP, guys, pay close attention to those US listed funds. So again, VT, maybe look at some growth ETFs, or again, even dividend ETFs, like I've talked about on here pretty recently, like VYM. I think you could find a lot of good options out there to increase the income if that's what you want and you want to maximize, because you can't do it in any other account. I think these could be great dividend ETFs to hold. I know a lot of people still like SCHD, the one that I sold off back in the Terrafor to buy the S&P 500. As I can reiterate here, I think a lot of investors will detriment themselves thinking because they get the 15% waived on those dividends that they should just be holding dividend stocks. But I'll remind you, if you're young, sometimes focusing on growth can be more prevalent, as I completely sold out of this back in April 28th. And since then, I mean, SCHD, not including the dividend, is only up 2.5% against me buying the S&P 500 literally on that same day, just pivoting out to being up 20. I mean, I'm up 25% almost. So I'm getting a much higher rate of return from that aspect, being more growth oriented. So again, I think it's, for me specifically, being a growth investor, these are pretty negligible at this point, considering, again, most of my money's in VOO. But if that's not you guys, don't do yourself this great disservice, and just make sure you're well aware of how to maximize the returns of your tax advantaged accounts. But I'm going to pass the question off to you. What do you hold in your RRSP and your TFSA? Are you balancing them differently based on that withholding tax? I'd love to hear about all of it in that comment section below. And as always, I look forward to catching you in the next one.